Hello and welcome to Daily News Simplified, an analysis of the Hindu newspaper from UPSC perspective. Today we will discuss the Delhi edition of the Hindu newspaper dated 6 December 2019. And the articles that we will discuss are displayed on your screen. So let us start our discussion. Now this article on page number 10 highlights the issues with the new seeds bill which has been introduced in the parliament and is under the consideration of parliament. So in this article, the author compares the provisions of this new seeds bill with that of a previous bill which was introduced and passed by the parliament in the year 2001. And that bill was known as the Protection of Plant Varieties and Farmers' Right Act of 2001. That is the PPVFR Act of 2001. So this shall become important for us from General Studies paper 2 because it talks about the various rights of the farmers and also from our preliminary examination point of view, and it will fall under the rights issues. Now this Act of Protection of Plant Varieties and Farmers' Right 2001 was in news in the month of May also. And that was in news because of an issue between the PepsiCo and the farmers in Gujarat because of the cultivation of a variety of potato which was claimed by the PepsiCo. And at that time also, we covered the basic features of this PPVFR Act of 2001. Now in this article, what we will do is that we will revise the basics of this act, that is the Protection of Plant Varieties and Farmers' Right Act 2001 from that DNS video. And after that, we will analyze the various issues with the new seeds bill and what are the provisions of this new bill as compared to that of the PPVFR Act of 2001. Now before understanding the various aspects of this PPVFR Act of 2001 and the issues with the new seeds bill, let us first understand the background in which this PPVFR Act was passed by the Parliament in the year 2001. So here we need to understand that in the year 1994, the agreement on trade-related aspects of intellectual property rights was signed. And India also agreed to this TRIPS agreement. And this agreement falls under the World Trade Organization. So this was the TRIPS agreement of the WTO and India also participated in it. Now India signed this TRIPS agreement in the year 1994 and also in the year 2002 India joined another important convention which is known as the International Union for the Protection of New Varieties of Plants. Now as India has agreed to the TRIPS agreement and also to the UPOV convention, it has led to the introduction of intellectual property rights over the plant varieties. Now the issue with India signing both the TRIPS agreement and the UPOV convention is that both these agreements run counter to two other important international conventions to which the India is also one of the parties. And these are the Convention on Biological Diversity or the CBD and the International Treaty on Plant Genetic Resources for Food and Agriculture. Now this 1992 Convention on Biological Diversity provided for prior informed consent of the farmers before the use of genetic resources, and also it provided for the clause of fair and equitable sharing of benefits arising out of their use. So in case if the private companies are taking use of any genetic resources which was used by the farmers, they will have to take a prior informed consent of those farmers, and also there needs to be fair and equitable sharing of the benefits which arise out of use of such genetic resources. Secondly, the International Treaty on Plant Genetic Resources for Food and Agriculture recognized the farmers' right to save, to use and exchange and sell farm-saved seeds. So this provided all the rights to the farmers regarding the use of the seeds which they were using. Now as India had signed the TRIPS agreement which provided for intellectual property rights and also these two conventions which provided for farmers' right. So in this background, India had to balance the provisions of all these conventions. And accordingly, it created an act which was known as the Protection of Plant Varieties and Farmers' Right Act of 2001. So the PPVFR Act of 2001 tried to strike a balance between the TRIPS and UPOV on the one hand and that with the CBD and the International Treaty on Plant Genetic Resources for Food and Agriculture on the other hand. Now, how did this act strike a balance between these conventions? So on the one hand, it provided intellectual property rights as an incentive for the technological innovations. However, on the other hand, it provided strong provisions for the protection of farmers' rights. Now we note that the intellectual property rights are important because they provide incentive to the private companies to invest in research and innovation. And that is important for thriving of the seed industry. However, at the same time, it was important to protect the rights of the farmers. And that is mainly because the farmers have been protecting the seeds and using them for generations. So this Protection of Plant Varieties and Farmers' Right Act of 2001 tried to strike a balance between these two aspects. Now in this background, let us understand the various aspects of this PPVFR Act of 2001, and after that we will look at the various issues with the new seeds bill that has been introduced in the parliament, and what are the contentious issues in the new seeds bill and how it dilutes the provisions of the PPVFR Act of 2001. So the Protection of Plant Variety and Farmers' Right Act 2001 is an act of the Parliament of India, and it was enacted to provide for establishment of an effective system for the protection of plant varieties, the rights of farmers and the plant breeders. And this was done in order to encourage the development and cultivation of new varieties of plants. And to accelerate the agricultural development in India, it was realized that it is necessary to protect plant breeders' rights to stimulate investment for research and development for the development of new plant varieties. So in order to develop new plant varieties and to improve investment and research in these new plant varieties, it was realized that such an act should provide protection to the rights of the plant varieties, the rights of farmers as well as the plant breeders. And such a protection was likely to facilitate the growth of seed industry, which will ensure the availability of high quality seeds and planting materials to the farmers. So such a protection has been provided in this act to promote and boost investment and research in new plant varieties, and also to facilitate the growth of seed industry. And this will ensure the availability of high quality seeds and planting materials to the farmers. Further, this act was enacted in accordance with the Agreement on Trade-Related Aspects of Intellectual Property Rights, or the TRIPS of the WTO. And as India signed the TRIPS agreement under the WTO, India enacted the Protection of Plant Varieties and Farmers' Right Act 2001. So in accordance with the principles of the TRIPS, it provides intellectual property rights to the plant breeders, researchers and farmers. And under this act, the rights are provided for a new variety and the denomination which has been assigned to this variety by the breeder. So for example, the PepsiCo has provided a brand name to this variety of potato. So that is also protected under this act. However, certain rights have also been provided to the farmers in this act. Now under this act, the farmers are entitled to save, use, sow, resow or exchange or sell their farm produce, including the seed of a registered variety, in an unbranded manner. So the farmers can also use the variety of seeds which have already been registered by other companies or other farmers. However, in using those seed varieties or the registered seed varieties, they will have to sell or exchange their farm produce in an unbranded manner, which means that the farmers cannot sell this variety which has already been registered by other persons under the name of a new brand. And if a farmer's variety is registered under this act, it is exempted from the payment of any fee. Further, the protection is provided for almost 15 years in case of trees and 18 years in case of vines. Further, the farmers can claim compensation if the registered variety fails to provide expected performance under the given conditions. So for example, if the PepsiCo indulges in contract farming with farmers of a particular area, and if that variety does not provide expected performance, the farmers can claim compensation in such a scenario. So this is also one of the important rights that have been provided to the farmers. Now the rights that have been provided under this act to the person or the company which registers a variety of plant or seed, they have an exclusive right to produce, sell, market, distribute, import and export that kind of variety. Further, if these rights are compromised, then civil and criminal remedies have been provided in this act. However, if a company tries to monopolize a kind of variety of seed, the government has provided benefit sharing and compulsory licensing in case of registered variety. and the government can invoke the provisions of benefit sharing and compulsory license in case the registered variety is not made available to the public at a reasonable price. And in case of compulsory licensing, the government can provide rights to another company to produce or use that kind of seed variety so that the prices become low and the company is not able to undertake the monopolistic business policy. Further, this act provides for compensation to rural or village communities if any registered variety has been developed using any variety in whose evolution such village or local community has contributed significantly. So, if a village or a rural community has contributed in the evolution of a particular variety, and if another company gets it registered, then these villagers and rural communities have to be compensated by that company. So, for example, a company A gets a seed S registered, and in the evolution of this seed or plant variety, the village or the rural community has contributed. So, in such a scenario, the company A will have to compensate the rural communities as well as the villagers. Now, as this act provides rights to the plant breeders to sell, market, or distribute their product, and also it provides right to the farmers who can also use a registered variety, however, in an unbranded manner, it has led to this issue which has arisen in the state of Gujarat, where PepsiCo has sued some of the farmers for growing the variety which was registered by Pepsi. Now, after protests by the farming communities and farming organizations, the Pepsi has now withdrawn the case. Further, an authority has also been created under this act, and the name of this authority is the Protection of Plant Varieties and Farmers' Rights Authority of India. So, it is a statutory body and has been created by the Plant Varieties and Farmers' Right Act of 2001. So, the important points for us from the preliminary examination point of view are that this act was created in 2001 in accordance with the TRIPS agreement of WTO. Further, this act provides intellectual property rights to the variety as well as the denomination which is assigned to it by the breeder. Further, it provides rights to farmers, and under these rights, the farmers can use already registered variety of seeds, however, in an unbranded manner. Further, it also has provisions of benefit sharing and compulsory licensing, and also an authority has been created under this act. Now, after understanding the various provisions of the Protection of Plant Varieties and Farmers' Right Act of 2001, let us look at some of the issues with the new seeds bill that has been introduced in the parliament. Now, according to government, the main objective of introducing such a new seeds bill is to improve the seed replacement rates in Indian agriculture. Now, besides the seed replacement rates, the government also wants to clearly specify the standards for the registration of seed varieties and also enforce registration from seed producers to seed retailers. Now, what seed replacement rates means is that the government wants that the farmers should keep on updating the seed variety that they are using. Now, usually what happens is that farmers keep on using the same kind of seed that they have been using for generations, and as such it impacts the productivity of the agriculture, etc. And in this case, the government wants to shift from the farm saved seeds to certified seeds which are produced by the private companies, etc. So, to increase the seed replacement rates, the government wants that the farmers should now shift from the farm saved seeds to certified seeds. Now, these certified seeds have higher and more stable yields as compared to the farm saved seeds. However, the issue here is that these certified seeds are generally produced by private companies, and their role in the seed market has been increasing in the past few decades in Indian agriculture. Now, what this does is that due to increased participation of the private sector, it creates a kind of monopolistic attitude on the part of the private players who are involved in the production of certified seeds. And as such, they keep on charging high and exorbitant prices for these seeds. And accordingly, the input costs for the agriculture keep on increasing. And that is one of the concerns for the farmers. So in that case, this PPVFR Act of 2001 tried to strike a balance between the interests of the private companies with that of the rights and interests of the farmers. So in this background, the author has highlighted various issues with the new seeds bill which try to dilute the aims and objectives of the PPVFR Act of 2001. And first issue is related to the compulsory registration of seeds. So here it is important to understand that the Protection of Plant Varieties and Farmers' Right Act was based on voluntary registration. However, the new seeds bill insists on compulsory registration of seed varieties. So this new provision of compulsory registration of seed varieties can have an adverse impact on the benefits for the farmers. Now, for example, in the development of one particular variety of seed, if the farmer community was also involved, and as such, the company which has compulsorily registered the seeds under the new seeds bill will have the exclusive marketing rights for that seed variety. And as such, this new bill does not provide for any provision of benefit sharing that was provided in the PPVFR Act of 2001. So as such, it puts the farmers at disadvantage. That is mainly because it provides exclusive marketing rights to the private companies only, and at the same time it does not have provisions for benefit sharing which was provided in the PPVFR Act of 2001. So that is first issue related to this new seed bill which is under the consideration of Parliament. Second issue is related to the compensation for the farmers' role in the development of a seed variety. So regarding this, the PPVFR Act provided that if in the evolution of any seed variety, the farmers and the community played a key role, then a compensation should be provided to them. However, the new bill or the new seeds bill dilutes these provisions and private companies are left free to claim a derived variety as their own without giving benefits to the farmers. So under the new bill, the provision for compensation has been diluted again. And that stands against the rights of the farmers on the seed varieties. Now we note that there are various seed varieties which have been used and evolved by the farmers for generations. And at times the private companies register these seed varieties by just making few improvements without giving benefits to the farmers. And that is one of the issue that was answered in the PPVFR Act of 2001. However, this concern has not been answered clearly in the new seeds bill. Further, this PPVFR Act does not allow for re-registration of the seeds after the validity periods. Now here it is important to understand that the PPVFR Act provided that any company can register a seed variety only for a limited period of time, let's say 10 years or 15 years. However, the new seed bill provides for the re-registration of the seeds even after the validity period, which means that the private companies can keep on evergreening their patents on the seed varieties and thereby they can monopolize the seed market or that particular variety of the seed. So the issue here is that once the registration period of the seed variety was over, it could have been used and saved by the farmers for future usage, and the price of that particular seed variety would have dropped. However, as the new bill provides for re-registration of seeds, it can now create monopoly of the private players in the seed market related to that seed variety. And as such, the farmers will not be able to reuse those varieties of seeds at a lower price. Further, the new bill has vague provisions related to seed pricing. And as such, the private companies or the seed companies can fix the seed prices according to their own logic, and which can lead to increase or rising costs of cultivation for the farmers. So as such, the new bill has not answered the issue of increasing prices of the seeds because of the entry of the private players in the seed markets. Further, as we know that the compensation for the farmer's role was provided in the PPVFR Act of 2001. And accordingly, if a registered variety failed to provide its promise of performance, the farmers could claim a compensation before an authority which was created under the PPVFR Act, which was known as the PPVFR Authority. So any claim of compensation was heard by this PPVFR Authority. However, the new bill does away with this provision, and it provides that disputes on the compensation have to be decided as per the Consumer Protection Act of 1986. Now the issue here is that these consumer codes are not very farm friendly, and as such it can adversely impact the rights of the farmers which were protected under the Act of 2001. Further, the new bill makes ambiguous provisions to make the compensation process even more complicated. And according to the new bill, the farmers become eligible for the compensation if a plant variety fails to give expected results under given conditions. Now, this term given condition, which has been introduced in the new seed bills, creates the problem of ambiguity. And that is because it is difficult to define what are these given conditions. And the seed companies can misuse and exploit these provisions to their own advantage. So, in short, we have learned that the new bill provides for compulsory registration of seeds as against the voluntary registration which was provided in the PPVFR Act of 2001. Secondly, the compensation for the farmer's role in the development of seed variety was provided in the PPVFR Act of 2001. However, the new bill dilutes this provision of benefit sharing with the farmers and the community. Thirdly, it provides for evergreening of the patents on seed varieties, and that is provided through re-registration. And as such, it can create monopolistic attitude of the private seed companies. Thirdly, the bill fails to control the seed pricing, which is an important input in the agriculture, and that is known to create high cost for the cultivation to the farmers, and as such it reduces the profit margins of the farmers. And finally, the disputes related to the compensation were decided by the PPVFR authority. However, according to the new bill, this will not be decided by the PPVFR authority and will be decided by the consumer courts, and which are generally not very farm friendly. And lastly, they have entered a new clause that is known as given conditions, which make it ambiguous for the farmers to claim the compensation. So these were few aspects of the PPVFR Act of 2001, and what are the issues with the new seeds bill. With this, let's take up the next article. Now, this article on page number 15 talks about the RBI's guidelines for the payments bank's small finance bank license. So this will become important for us from preliminary examination point of view under the topic economic development. And if you go through the previous year questions, you will find that in the year 2017, there was a question related to the purpose of setting up of the small finance banks in India. So in this background, let us understand what are these small finance banks, what is the scope of their activities, and how are these banks different from the payment banks, and what would be the impact of these RBI guidelines on the small finance banks. So regarding the small finance banks, you should note that these are differentiated banks. Now, differentiated banks means that they have a different scope as compared to the usual commercial scheduled banks. Further, the objective of creating small finance banks is different, and also they have a limited exposure to various risky financial services. However, as far as the main objective of these small finance banks is concerned, they have been created with the purpose of increasing the financial inclusion. And that is why they are known for primarily undertaking basic banking activities of accepting of deposits and lending in unserved as well as underserved areas and the sections. So as such, the main purpose of setting up of these small finance banks is that they are aimed at increasing the financial inclusion, and they do their lending and deposit activities to the underserved or the unserved sections of the society. So accordingly, their scope of activities include acceptance of deposits and extending of loans. However, they will be targeted at the unserved people or the unserved sections of the society. Secondly, they can undertake financial services. However, these will be non-risk financial services, and they can include the distribution of mutual funds, insurance products, pension products, etc. However, there is a condition that they can do so only with the prior approval of Reserve Bank of India. Further, the main target that has been set up for them is that they have to open at least 25% of its banking outlets in the unbanked rural centers. Fourthly, they can sell foreign exchange to the customers. However, there is no restriction for them regarding the area in which they can operate. So they can both operate in the rural as well as the urban areas. However, the target should be that 25% of their banking outlets should be in unbanked rural areas. So that is the only condition regarding the area of operation of such small finance banks. Now, these small finance banks are generally differentiated from the payments banks. So let us understand what is the key difference between these two terms. Now, both these payments banks and small finance banks are differentiated banks, and they have been created with the object of promoting the financial inclusion. However, the key difference is that the small finance banks can undertake both the deposit as well as lending activity. However, the payment banks cannot lend the loans. So this means that they are only involved in deposit taking activities. Further, the payment banks cannot accept deposits more than rupees 1 lakh. So there is limit on the amount of deposits that the payment banks can take. Further, these payment banks need to invest 75% of their deposits in the government securities, which have a maturity of up to 1 year. And the balance of 25% of the deposits should be with the commercial banks. And this clause has been inserted for the payments bank to secure their position and so that they do not get involved into risky financial activities. And the main purpose is to secure the deposits of the people who are depositing under the amount of rupees 1 lakh only. So this is aimed at reducing the risks that are undertaken by the payments bank. So these are the key points of differences between the small finance banks as well as the payment banks. So after this, let us look at what are the highlights of the RBI's guidelines on these small finance banks. So the guidelines are related to the various aspects of the functionings of the small finance banks. So first is, who are the eligible promoters who can create such small finance banks? Then there is certain minimum capital requirement that should be followed by these banks. Also, what are the kind of prudential norms that are to be followed by these banks? And then there are certain priority sector lending requirements so that they can target the unserved banking population to increase the financial inclusion. So regarding the eligible promoters, you should note that Indian citizens who are having at least 10 years of experience in banking and finance at a senior level can be the promoters for such small finance banks. Besides these people, companies or societies which have a successful track record of running their business for at least a period of 5 years. So for individuals, this condition is 10 years. However, for companies and societies which have a successful track record of running business for at least 5 years can be eligible promoters of these small finance banks. Now, besides individuals and companies, there are other existing NBFCs, microfinance institutions and local area banks in the private sector. They can also be eligible promoters for these small finance banks. So in this case, the NBFCs, microfinance institutions and the local area banks can also participate. So there can be individuals, then there can be companies or societies, and then these financial players can also enter into these small finance banks. Now, as far as the capital requirement is concerned, the minimum equity capital of these SFBs shall be rupees 200 crores. So regarding this, to increase the participation of cooperative banks, etc., RBI has put a condition that those primary urban cooperative banks which want to create or transition into a small finance bank, they will need an initial requirement of net worth to be about rupees 100 crores. So they have relaxed this norm of 200 crore. However, these urban cooperative banks will have to increase their minimum equity capital to rupees 200 crores within the next 5 years. And one of the important points for our preliminary examination is that these SFBs will be given scheduled bank status immediately upon the commencement of operations. This is because they will be operating according to the schedule of the Reserve Bank of India Act. Now, regarding the various norms like the CRR and the SLR, etc., these banks will be subjected to all the prudential norms and the regulations of the RBI which are applicable to the existing commercial banks. And as such, these banks will also have to maintain a cash reserve ratio CRR or a statutory liquidity ratio SLR. Now, all these aspects can be extremely important for us from the preliminary examination point of view, so you should keep them in mind. Now, regarding the priority sector lending, the small finance banks will be required to extend 75% of their loans for the priority sector. And we note that for commercial banks, this requirement is quite less as compared to the 75% requirement for these small finance banks. And further, there should be dominance of small value loans, which means that the basket of loans which are provided by these small finance banks should not be of very high value. So in order to ensure that the bank extends loans to the small borrowers, at least 50% of its loan portfolio should constitute loans and advances of up to rupees 25 lakhs. So the 50% of the loans which are given out by the SFBs should only be up to rupees 25 lakhs. And this has been done in order to incentivize or reach or extend the loans to the small borrowers. So for our preliminary examination, these guidelines of the RBI on small finance banks are important. Their comparison with the payments banks is also important, and also what is the scope of activities of these small finance banks. Now, if you go through the previous year question that was asked in 2017, it reads, what is the purpose of setting up of small finance banks in India? First is to supply credit to small business units. So as we have learned, it encourages lending to the small borrowers, which is correct. Secondly, to supply credit to the small and marginal farmers, which is also correct because the requirement is that 75% of the loans should be extended to priority sectors. And thirdly, to encourage young entrepreneurs to set up business, particularly in rural areas. So this is not the objective of small finance banks because it does not encourage the entrepreneurs. However, it can provide loans to these young entrepreneurs. So thus the correct answer will be A, 1 and 2 only. And with this, let's take up a next article. Now in this news article on page number 15, the National Investment and Infrastructure Fund of India and the Canada Pension Plan Investment Board have agreed that the CPPIB will invest up to $600 million through the NIIF Master Fund. So in this background, let us understand what is meant by the concept of Sovereign Wealth Fund and what are the key aspects of the NIIF. And that will be important for preliminary from our economic development. Because if you look at the previous year questions, you will find in the year 2017, there was a question related to National Investment and Infrastructure Fund. Now we are studying what is meant by the Sovereign Wealth Fund because National Investment and Infrastructure Fund is a type of quasi-sovereign wealth fund. So in this background, you should note that a sovereign wealth fund is an investment fund which is set up by some country. And they set up such funds in order to invest in the global markets. And these investments can be in the form of shares, bonds, real estate projects, etc. Now these funds are called as sovereign wealth funds. This is mainly because they are generally owned by sovereign nations, and that is why the term sovereign wealth fund has been created. So the second point that should be noted about these funds is that it is funded through the foreign exchange reserves which are held by the countries. And thirdly, this money is invested globally to make optimum profits through these sovereign wealth funds. So the countries utilize their foreign exchange reserves to invest in various investments across the world to gain profits, etc. Now, one of the examples of sovereign wealth fund is Norway, and which is operating the world's largest sovereign wealth fund, which is the government pension fund. And this has a corpus of about $1 trillion. Further, China has set up a Chinese investment corporation, and that is also a form of sovereign wealth fund. So as we have learned that the sovereign wealth funds are owned by sovereign nations and they invest in various areas to gain profits, and this is done through the foreign exchange reserves. So in this background, let us understand some facts related to the National Investment and Infrastructure Fund. So regarding this, you should note that it is a quasi-sovereign wealth fund. So why is it called a quasi-sovereign wealth fund? That is because only 49% of it is owned by the Indian government, as against other sovereign wealth funds which are owned by the sovereign nations. And secondly, the remaining 51% are owned by domestic or foreign investors. So regarding this, you should note that it was established in the year 2015 by the Government of India. And in 2017, Abu Dhabi Investment Authority became the first international investor in this NIIF. Now, as the government owns only 49% stake in this National Investment and Infrastructure Fund, it is known as a quasi-sovereign wealth fund. So what is the role of this NIIF? So it should be noted that it provides equity support to those NBFCs and financial institutions that are engaged mainly in infrastructure financing. So the main purpose of NIIF is the infrastructure financing. So it provides equity as well as debt to the commercially viable infrastructure projects, and which can also include those projects which are not functioning as of now and are known as stalled projects. So these are few highlights of the Sovereign Wealth Fund and the National Investment and Infrastructure Fund. And if you look at this question that was asked in 2017, it reads, with reference to the NIIF, which of the following statements is or are correct? First is that it is an organ of Niti Aayog, which is incorrect because it is not owned by Niti Aayog. And secondly, it has a corpus of rupees 4 lakh crores at present, which is also incorrect because At that time, the corpus of NIIF was only 40,000 crores. So the correct answer here was D, that is neither 1 nor 2. So these are a few points, and with this, let's take up the next article. Now, in the latest meeting of the Monetary Policy Committee of RBI, it has decided to keep the policy repo rate unchanged at only 5.15%. Now, this has come as a surprise for everyone. That is because the RBI has been consecutively reducing this repo rate. And the RBI in the past has cut the policy repo rate cumulatively by about 135 basis points in the last 9 months to revive investments in the economy. So this pause in the cut in the policy rates surprised the markets, and that is mainly because the markets expected that the RBI would further reduce the repo rate by 25 basis points in order to revive the economic slowdown that the Indian economy is undergoing presently. So in this scenario, the repo rate presently stands at about 5.15%, the repo rate stands at about 4.90%, and marginal standing facility stands at about 5.40%. And accordingly, the bank rate also stands at about 5.40%. So in this background, let us understand what is monetary policy transmission and how is this repo rate transmitted into investments in the economy, and what is the impact of RBI changing these repo rates. So in this background, what will be the impact if the RBI increases the repo rate, and what would be the likely impact if the RBI reduces this repo rate. So this shall become an important part of preliminary examination under the topic economic development. And after that, we will look at why did the RBI take such a decision to keep the policy rates unchanged. Now first, let us understand what is meant by this term monetary policy transmission. Now the Reserve Bank of India uses monetary policy tools like repo rate and reverse repo rate to control the money supply in the economy. Now, as you would have read in the economy, the repo rate is the rate at which the commercial banks would borrow from the RBI, while the reverse repo rate is the reverse of this rate, and it is the rate of interest they would earn when they deposit funds with the central bank. Now, normally the Reserve Bank of India keeps this reverse repo rate at a lower rate as compared to that of the repo rate. Now, in this context, the monetary policy transmission refers to the commensurate changes in the rate of interest on the loans with the changes in the policy rates like the repo rate or the reverse repo rate. So simply the monetary policy transmission means what will be the impact on the interest rates in the market when the RBI changes its policy rates like the repo rates. Now in this case, we will look at two scenarios with the help of a flow chart. Now first is that what will be the impact if the RBI reduces the repo rate. Now, as we have read, the repo rate is the rate at which the commercial banks borrow from the RBI. Now, if the repo rate is reduced, the banks will avail loans from the RBI at a lower interest rate. Now, this will lead to a reduction in the rate of interest on the loans in the market. So, all the borrowers in the market will be able to avail the loans from the banks at a lower rate of interest. Now, if the borrowers are able to borrow at a lower interest rate, it will lead to an increase in the investment and consumption expenditure. And ultimately, it will lead to an increase in the GDP growth rate, because as we know that simply when the investment and the consumption increases, the GDP growth rate increases. Now, conversely, if the RBI increases the repo rate, the banks will avail loans from the RBI at a higher rate of interest. Now, as the banks are borrowing from the RBI at higher rate, it will lead to an increase in the interest rate on the loans for the borrowers in the economy. And due to this, there will be a decrease in the money supply because the borrowers will not find it attractive to take loans at such high interest rates. Now, this measure is generally implemented to control the inflation. And the negative impact of this is that when the repo rate increases, the growth generally slows down. Now, although theoretically the impact of changes in the repo rate by the RBI on the economy has been explained simply. However, in reality, such a correlation is not that simple, and it depends on various other factors besides the changes in the repo rates. Now, why has the RBI kept these policy rates unchanged? Now, you might be knowing that the RBI has cut the policy rates by almost 135 basis points in the last 9 months. And all these have been done in order to improve the economic slowdown scenario. However, presently the RBI believes that such changes in the repo rate take certain time to get reflected due to inefficient monetary policy transmission. And that is why the RBI has decided to analyze the impact of the previous rate cuts in the policy rates. And accordingly, they will decide in the future if these repo rates should be reduced or not. Secondly, the RBI is expecting that the rate of inflation in Indian economy will be on the higher side. And that is mainly due to increase in the prices of food commodities. And presently, the CPI, that is the Consumer Price Index, which is a measure of the inflation in Indian economy, it has increased to about 4.6% in October 2019. And we note that the target for inflation under the monetary policy targets is 4%. So that is why this present CPI has already breached the targets of 4%. So which has made RBI skeptical that further rate cut can lead to an increase in the inflation in the Indian economy. And that is why it has decided to keep the policy rates unchanged as of now. Further, it was argued that the RBI should decrease its repo rate in order to increase investments so that it can counter the economic slowdown in the country. However, it has been asserted that in response to the economic slowdown, the government has already announced a number of measures. And these include reduction in the corporate tax rates, etc. And that is why the RBI is expecting that such measures which are taken by the government will be reflected in improved growth rate. And finally, the RBI has lowered the real GDP growth forecast for the financial year 2019 and 20 from 6.1 earlier to 5% presently. So these are few highlights of the repo rates which have been kept unchanged by the RBI. Now this news article on page number 15 reads that India's foreign exchange reserves have crossed $450 billion for the first time. And this has been revealed by the latest data which has been released by the Reserve Bank of India. So this will form an important part under preliminary examination, again under economic development. So in this article, we will try to understand what are the components of foreign exchange, what are foreign currency assets, and then what is meant by the term special drawing rights. And after that, we'll look at the reasons for the increase in foreign exchange reserves and how the increase in Forex reserves would benefit India. And in that, mainly we will look at a term which is important, which is known as import cover. Now, what are these foreign exchange reserves? The foreign exchange reserves are the reserve assets held by a central bank in foreign currencies. For example, in India, the RBI is the central bank and it maintains a foreign exchange reserve which is composed of foreign currencies. Now, India's foreign exchange reserve comprises of the foreign currency assets, for example, dollars and pounds. Now, this foreign exchange reserve also comprises of the gold reserves, special drawing rights or SDRs, which are composed of different currencies and is maintained by IMF. It also comprises of RBI's reserve position in IMF. So the foreign exchange reserves are the reserve assets which are held by central bank in terms of foreign currencies, and India's foreign exchange reserve comprises of foreign currency assets, for example dollars and pounds, gold reserves, special drawing rights, and RBI's reserve position in IMF. Now let us understand what are special drawing rights and RBI's reserve position in IMF. Now special drawing rights is a kind of international currency created by the International Monetary Fund. It involves a basket of national currencies, and currently this SDR basket has 5 currencies. These 5 currencies are the US dollar, the euro, renminbi or yuan, which is the Chinese currency, yen, which is the Japanese currency, and the 5th one is the British pound. So the SDRs are a basket of national currencies maintained by the IMF, and it includes 5 currencies which are US dollar, euro, renminbi, yen, and British pound. Now let us understand what is meant by the reserve position of a central bank in IMF. It is also called the reserve tranche in IMF. Now each member country maintains a quota of special drawing rights or designated foreign currencies with IMF. And this quota can be used by that country whenever it is required. Thus the reserve tranche portion of the quota is that portion which is accessible at any time to the member country. Now, as we have learned that the foreign currency assets of India are in special drawing rights. So regarding this, you should note that it was created by the IMF as an international reserve asset in the year 1969. And this was created in order to supplement the member countries' official reserves. Now, one important point to be noted about these SDRs is that it is neither a currency or nor it is a claim on the IMF. However, now although it is not a currency, It is a potential claim on the freely usable currencies of the IMF members. So in this case, you should note that these SDRs can be exchanged for the currencies which comprise the SDR basket. For example, these SDRs can be exchanged for dollars, euros, pounds, yens, or yuan. However, these SDRs are not currencies in themselves. So this is an important fact for us from preliminary examination point of view. And regarding the value of SDRs in terms of US dollars, it is determined daily by the IMF. Now, what is the reason for the increase in the foreign exchange reserves of India? So it has been mainly due to increase in the foreign direct investment. And this FDI has rose to $20 billion in the first half of the 2019 and 20. And this was only $17 billion in the last year. Further, the increase in foreign portfolio investment has also led to an increase in the Forex reserves for the RBI. And if you compare the present situation with the situation last year, you will note that there has been a net inflow of $9 billion between April to November 2019. However, last year during the same period, there was net outflow of $15 billion. So as there has been a net inflow of the foreign portfolio investment, it is reflected in the increased Forex reserves for the RBI. Now after this, let us look at one of the important terms and one of the important benefits of these foreign exchange reserves, and that is known as the import cover. And one of the important indicators of the stability of the currency of a country is the import cover that it possesses. So let us understand what is meant by this term import cover. Now the term import cover has been asked in the year 2016 in the preliminary examination. Now first let us understand what is meant by the term import cover. So it is the number of months of import that can be paid by a country's foreign exchange reserves. Now how much foreign exchange reserve is enough for a country? So according to one rule of thumb, reserves that can cover the 3 months worth of imports are adequate. However, there is no fixed rule to analyze as to how much reserve is enough for paying the imports. So in this regard, a general understanding is that this import cover should be of about 3 months. Now why is maintenance of such an import cover important for India? Now the importance of the import cover was realized during the 1991 crisis. This is because during the period of 1991, India did not have enough foreign exchange reserves to pay for its imports. And the import bill was rising because of continuous import of oil, etc. Further, in the year 2013, when the Indian currency was falling, the foreign exchange reserves fell to about $275 billion. And in that case, the import cover declined to about 7 months. So due to such emergency conditions, when the currency starts dropping and the import bill starts increasing, the foreign exchange reserves become important. So that is why the import cover of these foreign exchanges is important for India to maintain the stability of its currency and the economy. Now if you look at the question that was asked in 2016, the question reads, which of the following best describes the term import cover sometimes seen in the news? So in this case, the correct answer was D, that is, it is the number of months of import that could be paid for by a country's international reserves. And with this, let us move on to the next article. Now, this article on page number 4 is related to Dr. Bhim Rao Ambedkar, who was the chief architect of the Indian Constitution. And today is the Mahaparinirvana Divas of Dr. Bhim Rao Ambedkar. Now, Dr. Bhim Rao Ambedkar is one of the important personalities of Indian history, which can be extremely important for us from the preliminary as well as mains examination point of view. So the various contributions of Dr. Bhim Rao Ambedkar can be important for us under the preliminary as well as mains examination under the topic History of India. So some of the important contributions of Dr. Bhim Rao Ambedkar include the important publications by Dr. Ambedkar. Then it will include certain important organizations which were established by Dr. Ambedkar for the upliftment of the depressed classes. And which all important movements were started by Dr. Bhim Rao Ambedkar can be important for us from exam point of view. And besides this, you should be knowing that an important debate on the caste system between Dr. Bhim Rao Ambedkar and Mahatma Gandhi has already been asked in the mains examination in the year 2015. So in that background, you should go through the static sources for all these aspects. However, in today's PDF, you will find certain information related to Dr. Bhim Rao Ambedkar which can be important for us from the exam point of view. For example, it will provide you important publications of Dr. Baba Saheb, that is the Mook Nayak and the Buddha and his Dharma. So these are two important publications. Then there were important organizations which were established by him, like the Bahishkrit Hitkarini Sabha, which was established in 1923, then Independent Labour Party and the Scheduled Caste Federation. And the important movements were the Mahad March in 1927, the Temple Entry movement, and one of the important was the conception of the Communal Award by Ramsay MacDonald, Prime Minister of Britain. And after the Communal Award, the Pune Pact was arrived at between Dr. Bhimrao Ambedkar and Mahatma Gandhi. So in this context, you should go and read through the PDF about various aspects and also from your static history books. Now, if you look at this question that was asked in the preliminary examination of 2012, it reads, which of the following parties were established by Dr. B.R. Ambedkar? So some of the important works and initiatives of Dr. B.R. Ambedkar are important for us from preliminary examination point of view. So similarly, you should also learn about various other important contributors in the Indian nationalist movement and various other people who are historically important for us. So regarding this question, it reads the Peasant and the Workers' Party of India, the All India Scheduled Caste Federation and the Independent Labour Party. So here it should be noted that the first, that is the Peasant and Worker Party of India, was not established by Dr. B.R. Ambedkar, and hence the correct answer was B, that is 2 and 3 only. And again, if you look at the mains examination in the year 2015, a question was asked regarding the debate on the approaches and strategies for the amelioration of downtrodden between Mahatma Gandhi and Dr. B.R. Ambedkar. So that is why you should go through the static portions very diligently regarding important personalities in Indian history. Now, after today's discussion, let us take up these practice questions and the answer will be displayed after 5 seconds. First is that which of the following were published by Dr. B.R. Ambedkar? And the options are Mook Nayak, Buddha and his Dharma and Harijan. So as we clearly know that Harijan was a publication of Mahatma Gandhi. Hence the correct answer is B, 1 and 2 only. Second question reads, consider the following statement. SDRs is the international currency of IMF. Second is that SDR is based on US dollars value only. Now both the statements are incorrect because it is not an international currency. Secondly, its value is based on a basket of 5 currencies. However, it is valued in terms of US dollars. So the correct answer is D, neither 1 nor 2. Second question, the third question reads, payments banks can do deposit and lending both, which is incorrect because it cannot do lending activities. Secondly, small finance banks do not have to meet prudential norms of RBI, which is also incorrect. Hence the correct answer is D, neither 1 nor 2. With this, we conclude our discussion. Now let's take up the question for today.